What's going on, guys, and welcome back to another video. So yesterday Corsair Gaming released their earnings and I went through them and I actually thought, you know what, they're not too bad. And guess what happens? The stock price falls. As is always the case, the stock market can be quite temperamental, and when we expect them to do one thing, they tend to do the other. So on the day, they had actually fallen by as much as 8% and they dropped down to, I think, around $26.50. And they sort of recovered ever so slightly, and in the end they were 6.4% down on the day, which is a massive drop. And if we look at the sort of the 6-month chart, they're actually down 40% over the last 6 months. Now, granted, this sort of run-up was sort of potentially unwarranted, probably shouldn't have been up at $46 a share, and I sort of discussed this in my previous video on Corsair Gaming, and it was sort of partly down to Wall Street bets. Again, surprise, surprise. But yeah, they probably shouldn't have been up at $46 a share. So they are down massively, but it's probably not a fair representation. But for sure, I don't think that they should be down at $27, which, as you'll see from the title, is why I purchased some shares. Now, prior to the earnings, I actually had my strike price set at $25, where I would initiate a position if it did fall to that, just because I saw the stock chart and saw it was quite bearish, and I thought that if it does, and I was hoping that it would fall to $25, then I would start a position. And then yesterday I saw that the share price had fallen to $26.50, and I thought, you know what, this is just too good of an opportunity to pass up. And what's $1.50 per share, you know, in the long run? So I thought, forget the strike price that I've set. I'm going to open a position, and that's exactly what I did. So right now, Corsair is around 4% of my portfolio. So it's not the smallest position in my portfolio, but it's not huge either. But I'm definitely very bullish. And if it continues to fall, and you know, which is what I'm hoping it will do, then I'm going to increase that position even further. So in this video, we'll quickly run through the earnings report and talk about why Wall Street reacted so negatively to it. And then we'll also discuss why I think that they actually aren't a problem in the long term, and why I think that at this price, at $2.5 billion market cap, it's just so cheap for this stock, and I expect a quite significant return over the next couple of years or so. So this article here from Seeking Alpha reads that Corsair Gaming stock falls after Q2 misses and soft sales forecast. And as I said, that the stock fell by 8% within the day. So you would assume that they have absolutely massively missed their revenue estimates, they've massively missed their earnings estimates, but that wasn't the case at all, right? So we can see that revenue was up 24% year over year, which is really good. And you have to remember, right, that a lot of people have been saying that Corsair Gaming experienced really good revenue growth because of the pandemic, which is, you know, largely true. But that sort of revenue growth was not sustainable going forward. And when everything opens up again, they're not going to be able to grow. And we've clearly seen here that that's not the case, because revenue was up 24% year over year at a time when pretty much everything is open, right? So if people want to go out and enjoy themselves, they can do. That doesn't mean that people aren't going to still continue to game. And so I think that Corsair Gaming, as well as other companies within this industry, are starting to prove that whether there is a pandemic or not, you know, this is an industry that is growing and people will continue to game regardless. With that being said, though, they did fall short on revenue expectations, right? So they achieved $473 million of revenue, which was about $2.3 million short of the analyst consensus. Now, to be honest, I don't even think that that's really worthy of a discussion, right? So $2.3 million on $473 million is around 0.5%. So it's not really something that even needs to be discussed. In my opinion, that is just meeting expectations or materially meeting expectations. So I think that's fine. One thing worth a discussion, though, is adjusted earnings of 36 cents per share was 3 cents shy of analyst estimates. So they were around 9% short, which is more of a significant miss. And I think that that's probably, you know, part of what is sort of driving the share price down on these earnings. And then in addition to that, we can see that the adjusted EBITDA was $51.6 million compared with the consensus of $57 million. So again, that's around 10% miss. So that is quite significant. And like I said, I think that the earnings miss is what is sort of driving the sort of share price down. One thing to note, though, is that for the full year, they're expecting their sort of 2021 guidance to be in line with what they were saying at the last quarter. So just because we've sort of missed at this quarter, that sort of suggests that they're going to outperform on the next quarter. So that's good to see, and I think you need to look at a bigger picture rather than just looking every single quarter. And then flicking over to the earnings report, right, so we can see here that, as mentioned earlier, net revenue was $473 million, and that was an increase of 24% year over year. Very, very solid growth. And then we're looking at gross profit, right, so that was $130 million, an increase of 24% year over year in line with revenue, which shows that the gross margin has remained flat. So I'm happy with that. So gross margins of 27.6%. This is not a sort of a massively sort of profitable business in the sense that they've got gross margins of like 60 or 70%, But that's the type of business that this is, and we take that into account in our valuation. So as long as gross margins are remaining 27-28%, I'm happy with that, and that's what I've included in my valuation. One of the significant negatives here, though, is that operating income was $35 million, and that was a decrease of 4.7% year over year. So that's not a good sign, right? So we've seen revenue increase, we've seen gross profits increase, and yet operating income has actually decreased, right? So that clearly shows that we're sort of not managing our expenses as well as we should be. And we actually find out as to what that was due to, and I'll tell you why I'm not concerned by it in the long term. And then in terms of the balance sheet, which we'll get onto shortly, they had cash and restricted cash of $139 million, and then they've got $49 million capacity under their revolving credit facility, and total long-term debt of $270 million. Now, we will get onto the balance sheet just in a minute, but very quickly on that, they're using their free cash flows to pay down their debt, so that's a very good sign. And they have ample liquidity in case anything pops up in the meantime. So from a balance sheet perspective, this is not a concern for me at all. And I think that actually, for a business that is growing at these kind of rates, and it's still relatively small, $2.5 billion market cap, the balance sheet is pretty good. Now, one thing that does look really bad from their sort of second quarter highlights was their cash flow from operations, which was only $31.5 million, which decreased from $74 million in the same period last year. But we'll get into what was the driver of that decrease and whether we can expect sort of free cash flows or cash flows from operations and free cash flows to normalize into the future. Now, one of the statements from the CEO, Andy Paul, sort of reiterates the point I was making earlier, right? So he went on to say that our results highlight the strength of the underlying fundamentals of our business as gamers continue to purchase and upgrade their gear, even as entertainment outside of the home and travel began to open back up. He then went on to say that the midpoint of our full year outlook calls for run rate revenue of $2 billion compared to our pre-IPO revenue of $1.1 billion in 2019, which shows our strong improvement since then. So they have grown their revenue by almost 100% in 2 years' time, which is absolutely amazing growth, right? And for us investors, we are not expecting, and they don't need to sustain that level of growth going forward. But if they are able to sustain growth of, for example, 15% or 20% year over year for the next 5 years, and then something a little bit smaller than that, this is going to turn out to be a very, very valuable investment. So I'm happy for the sort of rate of growth that we're seeing, or that we've seen in historically. And I also think that going forward, we can expect at least 15 to 20% revenue growth going forward as well. So it's all looking very positive for this business so far. And the thing that I really like is that they are really investing in order to achieve that growth. So we can see here that we are investing in R&D, marketing and infrastructure as we remain focused on expanding our resources. As an example, we are extremely excited by the recent launch of our first camera, which has received an overwhelmingly positive response from the creator community. We have launched over 75 new products so far this year, which is an astounding pace of innovation, which it is. And if they can continue to just create new products which people actually want, then their revenues and earnings are going to grow as well along with that. And what I was referring to earlier with them using their cash flows to repay debt, we can see that they utilized increased cash flow to repay an additional $25 million in debt during the second quarter, and we remain focused on further optimizing our capital structure and exploring options to reduce the carrying cost of our debt. So these are all very positive things as well, and I think that management are allocating their capital correctly. Now, in terms of why their performance, at least in terms of profitability, hasn't been as strong as it has been in previous quarters, we can see here that during the second quarter, we experienced higher than expected costs for logistics, and we expect logistic costs to remain elevated in the third quarter. Shutdowns from the ongoing pandemic in several large regions we operate in also negatively impacted our operations. So what he's saying is that during, sort of in the short term, we're expecting our margins to contract, which is, more or less what we've seen. And he thinks that, this is going to go on into the third quarter as well. But over the long term, that doesn't mean that the business is any less profitable. It just means that due to the pandemic and a few other reasons, sort of their profitability has reduced momentarily. And then in the long term, we're expecting those margins to kick back up again. So that is fine. This isn't something that I think is going to continue sort of into perpetuity. So it's not really an issue for me. And then importantly, despite the fact that they've experienced a less profitable quarter, their full year 2021 outlook remains unchanged. So that's good. It means that in quarters 3 and quarters 4, we're expecting a little bit of an uptick. So adjusted EBITDA to be in the range of $245 to $265 million is very, very good. That puts them at an enterprise value to EBITDA multiple of around 10, which is really low for a company that is growing. Also for the industry that they're in, enterprise value to EBITDA of 10 is really quite low. Now, just before we move on to my own personal valuation model for the company, we'll take a quick look at the income statement and balance sheet. Now, we won't spend too much time on this, particularly on the income statement, because we've really already covered it in the discussions earlier on. However, we will take a look at the sort of operating expenses, and in particular the sales, general and administrative expenses, because this is where we're expecting to see a sort of a significant increase due to the logistical costs which management was citing earlier on, right? So we can see that their total operating expenses have increased by around 40% year over year, which is a significant increase when you consider that their revenues have increased by 24%. So as a general rule of thumb, it doesn't always work out like this, but generally speaking, your sort of operating expenses you would expect to sort of increase in line with your sales. Of course, it doesn't always work out like that, but that's not a bad rule of thumb to follow. And particularly your sales, general and administrative costs, you certainly generally expect those to increase in line with sales, because by and large, well, they're incurred as you make sales, right? So you're expecting those to increase sort of in line with each other, and of course that isn't the case. So we already know that revenues have increased by 24%, and if we actually look at what the increase for these sort of particular types of expenses were, so we see a 40% increase in sales, general and administrative expenses. So clearly the reason for that margin contraction is within operating expenses, and if we can rely on what management have said, which is effectively that these logistical costs have increased effectively due to the pandemic, and we're expecting those to sort of normalize, maybe not in Q3, but certainly from Q4 onwards, then we can expect the margins to increase again going forward. So that's definitely a positive sign, just to show that, okay, this may be just a sort of transient phase in margin contraction, and we're expecting those margins to expand once again once we're sort of out of the pandemic entirely. But honestly, other than that, everything else has remained fairly reasonable, right? So the sort of gross profits has increased by 24%, meaning that our gross margins have remained the same, so that's very good. Sort of interest expenses actually halved, which again is very good, and that goes to show that management are paying down their debt, which we was referring to earlier on. So all in all, it's actually, there aren't too many surprises in here, other than the fact that they're experiencing these greater sort of sales, general and administrative costs, and once those goes away, we're expecting the business to become more profitable once again. So all very positive that the sort of bad news that we've received for this quarter is just a short-term sort of downturn in the business. And then when we actually look at the breakdown and the composition of the revenue, this is where it actually gets quite exciting, right? Because we've got game and creator peripherals, which grew by 40% year over year, and they are the sort of the sector or the segment of their business which generate the greatest profits, the greatest gross margins. So if they can continue, right, if they can continue to grow their revenues in the game and creator peripherals at a pace which is greater than the gaming components and systems, then that's going to be very beneficial, because what we'll see is margin expansion over time, which will lead to greater profits for us, the shareholders. So that's very good. And then very quickly moving on to the balance sheet. So like I was saying earlier, their balance sheet is actually really good. They've got total current assets of $732 million, and we compare that with current liabilities of $494 million. So that's a current ratio of something like 1.7, 1.8, which is really good actually. It's pretty impressive for this business. So happy from a sort of liquidity point of view. If we look at their total assets, they've got $1.4 million in total assets, and compare that with total liabilities of $848 million. Now, from sort of total assets, I like to remove goodwill, generally speaking. So even if we remove goodwill, we've still got more or less sort of $1 million, or just over $1 million worth of total assets, excluding goodwill, which still exceeds total liabilities. So from a balance sheet perspective, very, very good actually. So there's no complaints from an investor's point of view. And again, not only that, they're cash flow positive and they're paying down their debt. So we're definitely expecting that this $270 million worth of debt is going to reduce over time. I mean, if you just look at what it was 6 months ago, right? So just at the end of December, it was $321 million, and they've already paid off $50 million of that. So give it a couple of years, and I expect that a lot of that debt will have sort of been chipped away at, unless they see sort of a high growth opportunity within the business, in which case they may decide to take on some more debt. Then that brings us on to what I believe the company is worth, right? So when I made the video a couple of months ago, I said that I believe that the intrinsic value of Corsair Gaming was around $30 a share, and this was using relatively conservative numbers. So if we actually look at what those numbers are made of, we can see 1 to 5 year revenue growth of 15%, 6 to 10 year revenue growth of 12%. Now, bearing in mind that they've achieved 55% in 2020, so far they're achieving around 24% in the current year. I think that 15%, it's safe to say, is pretty low, right? That puts us at 2021 revenue of 1.8 billion. And management say that we're expecting around 2.1 billion. So I think that 1 to 5 year revenue growth of 15% is very conservative. And we've got 6 to 10 year revenue growth of 12%. Again, I think that's conservative. Gross margins appear to be remaining sort of flat at 27%. So I think it's fair to use 27% going forward. Operating expenses, whilst we have seen a little bit of an uptick in Q2 and we're expecting another uptick in Q3, for the long term, I've not seen anything to suggest that that won't normalise back down to where it has always been. So I think that to leave it at 18% is probably fair. For free cash flow as a percentage of revenue, we had used 6%, which was the average of the last 2 years. But we can see that in 2020, they actually achieved 9%. Now, despite the fact that they had a lower free cash flow in their current quarter, I still think that sort of closer to 9% is probably a fairer representation of this business. But just to remain prudent, we'll leave it at 6%, and I think that that's probably fair. For terminal growth of 1.5%, to be honest, I'm going to change that, right? Because I think that a terminal growth of 2% for a business like Corsair Gaming in the industry that they're in is probably fair. You guys will know that I'll always use a terminal growth rate which is lower than the growth rate of the economy in which the company operates. So anything below sort of 3% seems to me reasonable. So I think 2% terminal growth rate seems fair, right? Weighted average cost of capital of 9.9%. It's a calculation which I won't run through today. And then I've already updated the cash and total debt figures, right? So we've got $138 million of cash, $270 million of debt. That brings us to an estimated intrinsic value of around $31, which is a margin of safety of 15%, which doesn't sound that huge, right? But you have to remember how conservative I'm being in these numbers. We've been seeing phenomenal rate of growth, and I honestly think that 15% is way too conservative. If they are able to keep up something like a 24% revenue growth rate, which is what they are sort of on track to do this year, that puts them at an intrinsic value of $44. So you can see just how much that the sort of valuation model can be swayed by change in the inputs, right? In fairness, I think that 24% is probably a little bit too high for the next 5 years. You know, I think they'll probably achieve something like 24% in 2021, maybe like 22% in 2022, and so on. And that will eventually sort of reduce down to somewhere closer to like 15%. But I think that if we go with 20% 1 to 5 year revenue growth, even then, right, we still get an intrinsic value of $38, which would be a margin of safety of 41%. So for me personally, I think that even using the most conservative numbers, there's definitely money to be made in this investment. And that's why I've invested in the business. One thing to bear in mind though, at least in the short term, is the fact that there is a lot of selling pressure and a lot of downward pressure on that share price due to the fact that Eagle Tree Capital, which is a private equity firm, sort of owns a majority stake in Corsair, which they purchased at a valuation of $525 million. And they are continuing now to offload their shares, which isn't a warning sign or anything like that. That's exactly what private equity firms are supposed to do. They make an investment and then they unload it after a few years at usually a very nice rate of return. But the fact that they are selling such a high number of shares because they are a majority shareholder in the company is obviously going to add some sort of downward pressure to the share price. So in the short term, you know, we may see lower lows, right? We may see sort of $25 and even below that potentially. But in the long term, I mean, I think that this stock should be at least $31, and that is right now. And of course, over time, it's going to far exceed that. So it's not really a concern to me as to whether the share price falls further in the short term. And if it does, I'm happy to increase my stake up to a relatively large holding within my portfolio. So anyway, guys, I hope that was useful. And until next time, thank you.